The top business stories live from the Sky News City studio. The Chancellor warns that expected debt interest payments could be revised higher by up to £30 billion in the autumn statement. Microsoft gets the green light to buy the Call of Duty maker Activision Blizzard. Plus, the UK's biggest wealth management firm, St James's Place, confirms it's carrying out an assessment of its fees and charging models following pressure from regulators. Good morning, this is Business Live with me, Ian King. We begin this morning with some breaking news concerning Nigel Farage. The former leader of the Brexit and UK independent parties became embroiled in a so-called debanking row in the summer when his Coutts account was closed. Well, our city editor, Mark Kleinman, now has some more details on where this story goes from here. Mark, what have you heard?
Yeah, that's right, Ian. Rarely can one man's personal banking arrangements have been the subject of so much scrutiny. But what I can reveal this morning, Ian, is that Nigel Farage is moving his personal bank accounts to Lloyds Banking Group, Britain's biggest high street lender. Now, this all comes about 2.5 months after the eruption of the debanking row, which cost Dame Alison Rose, the former NatWest Group chief executive, her job. Of course, just to recap, she acknowledged being the source of an erroneous and damaging story reported by the BBC, which claimed that Mr Farage's accounts with Coutts, NatWest's wealth management subsidiary, had been closed solely for commercial reasons. In the end, it emerged, of course, that there were criticisms of Mr Farage's political views within NatWest, and that was the reason why they had effectively debanked him. Now, I spoke to Mr Farage a short time ago, and he has confirmed this move to Lloyds to me. He said, after being refused banking facilities by 10 lenders, I am pleased to say that Lloyds has opened accounts for me. It's good to see that at least one high street bank is not politically prejudiced. Now, Lloyds has declined to comment on this move by Mr Farage to open his accounts with them. Lloyds has just said to me that it doesn't comment on customer relationships. And of course, this is not the end of the story, Ian, because Mr Farage has initiated legal action against NatWest. He's also filed a complaint with the Information Commissioner's Office. And in the next few weeks, we should hear the outcome of an independent review conducted by the city law firm Travers Smith into the scandal that took place at NatWest over the summer. So this isn't the end of the story, but it's an interesting development this morning that Nigel Farage is moving his personal banking facilities to Lloyds Banking Group, Britain's biggest high street lender.
Great stuff. Thanks, Mark. Now, the Chancellor, Jeremy Hunt, has told Sky News that people need to prepare for the worst as the world is in a very dangerous place. Mr Hunt said the UK is facing a very challenging environment, with debt interest likely to be as much as £30 billion higher in the autumn statement than was predicted in the spring. The Chancellor's in Marrakesh for the IMF World Bank meeting. He's been speaking to our economics editor, Ed Conway.
You talked obviously about the challenges for the UK economy. You've got the autumn statement coming up quite soon. So, you know, you're probably starting to get a sense of how things look right now, the numbers, the growth. Just, you know, is there good news that you're going to be able to tell us, or is it yet more challenges and yet more difficulties?
I think it's a bit of both, Ed. I think the British economy, compared to when I became Chancellor a year ago, has proved to be much more resilient than nearly every international organisation predicted. And people are looking at some of the underlying strengths. Our technology industry, which is double the size of Germany's, 3 times the size of France. Our life science industry. They're seeing that when it comes to the industries of the future, the UK has real strengths. But in the short term, we have challenges. We have a challenge with inflation, which is still too high. And we have the challenge of the international environment, where there are still a lot of shocks. And so I need, as Chancellor, to focus on resilience in the face of those shocks. I am very much hoping for the best, but I do need to prepare for the worst, because I think we can see that the world is a very dangerous place right now.
But preparing for the worst, I mean, even just looking domestically at your numbers, it would look like kind of interest rates are higher, so your debt interest costs are going to be higher. The economy isn't necessarily going gangbusters, so all of that is presumably means that the numbers aren't as hopeful as you might have hoped for at this point.
The numbers are definitely worse than what I faced in the spring.
Really, they are worse, are they?
Our debt interest is likely to be 20 to 30 billion pounds higher this year than we predicted in the spring. So, yes, it's a very challenging environment in the short term. But my approach to this is to say we will manage those short-term pressures whilst at the same time building for the long term, doing the things that mean that we can be confident we will be a successful and prosperous economy going forward. And as I look at the exciting things that are happening in the longer term in the British economy, I have a great deal of confidence, providing we take the difficult decisions necessary to get inflation down, to get our borrowing back under control. If we do these kinds of things, then we can be very confident of our future.
Well, Ed joins me now live from Marrakesh. Ed, the IMF came up with some growth forecasts for the UK earlier this week, which were widely derided. Did the Chancellor have anything to say about that?
I think they're very sceptical about them, and we covered that earlier on this week. Essentially, the IMF has forecast that the UK is going to be the weakest growing economy in the G7 next year. But there are some big question marks over some of the assumptions that underlie that. It doesn't take into account the fact that the economy's been upgraded recently. It seems to be based on slightly higher interest rate projections than are now kind of in place. So there are some question marks about it. But really, Ian, kind of when you look back when you take a step back and look at not just the UK, but look at Europe more broadly, what's striking actually, Britain isn't really an outlier when it comes to Europe. Everyone is weak. You know, everyone here across the European continent is weak. And that is something that people here at this meeting are genuinely concerned about. They look at America, they look at American growth as pretty robust at the moment. They look at China, struggling at the moment. But nonetheless, neither of those two areas, and Asia more broadly, are anything like Europe. Europe just does have this growth problem. And the UK, the Chancellor talks about being trapped in this low growth trap, definitely has that problem. What was interesting actually about the interview wasn't just his diagnosis on growth though, Ian, but the fact that we are coming up to the autumn statement. That's obviously coming up next month. They in the Treasury, including the Chancellor, have now seen the economic forecasts. They've seen what the Office for Budget Responsibility thinks the state of the economy is. They've seen the debt interest forecasts. And what we got from the Chancellor just there is a little sniff of what they might actually look like, and it's not very encouraging. 20 to 30 billion pounds more in debt payments. That implies, all else equal, there may well have to be cuts if he's going to actually keep to his fiscal rules. And that in turn means, well, maybe tax rises, maybe spending cuts. Maybe the autumn statement that's coming up is actually going to be quite grim. That's the mood messaging here. And obviously it's the first we've heard really from the Chancellor any hints on what's actually going to, what the kind of outlook is going to be for the autumn statement. So that is quite interesting. But as I say, and as you say, Ian, broadly speaking, a lot of people here, there's obviously extraordinary focus on what's going on in Israel and, of course, in Ukraine as well. But the concern in Europe is just why is there no growth? What can we do to kickstart it? And frankly, on top of that, you've got some miserable news coming from the Chancellor as well. So it's a not very positive outlook.
Thanks, Ed. Now, the Competition and Markets Authority has this morning cleared Microsoft's $69 billion deal to buy Activision Blizzard, publisher of the hit video game Call of Duty, after nearly 22 months of legal wrangling. The CMA initially blocked the deal, which has already been cleared in the EU and China, on the grounds that it would hurt competition in the cloud gaming market. Well, that led to claims from both Microsoft and Activision Blizzard that the UK was closed for business. But in August, Microsoft made a concession, offering to give Activision's cloud gaming rights for the next 15 years to Ubisoft, the French games publisher. Well, the regulators said today it was satisfied with that compromise. Joining me now is Sarah Cardell, Chief Executive of the CMA. Sarah, good to see you this morning. I'm struck by the words in your announcement. You clearly feel that Microsoft was throwing its weight around and trying to bully you.
We've been clear throughout this process that the merger between Microsoft and Activision could not go ahead if it would risk harming competition. We made that very clear, obviously, in our original decision when we prohibited the original deal. That was because we were concerned about the combination of Microsoft's already strong position in cloud with Xbox and with Windows, combining that with Activision's strong position in the gaming content. And Microsoft responded to that decision with a major concession, a fundamental restructure of the deal, putting those cloud streaming rights in the hands of an independent competitor, Ubisoft. So where we've got to eventually today is an outcome which preserves competition in this important cloud gaming sector and will give real reassurance to UK gamers that they will get the benefit of competitive prices and better services. But it's taken far too long. And there is nothing in this restructured deal that Microsoft couldn't have brought forward many months ago and saved, frankly, both the parties and us at the CMA a lot of time and money.
So how much time and money could have been saved?
Well, we have been through a full, what we call a phase one, an initial investigation, and then a full 8-month or so further investigation. At the end of that, we put out our prohibition decision. As you say, Microsoft came forward with this major concession in August. We took forward then a new investigation, which we have concluded today. But there is no reason why this restructure couldn't have come forward through that first in-depth investigation many months ago.
And why do you think Microsoft chose to take that approach?
I guess ultimately that's a question for Microsoft, but what we saw was frankly a minimalist incremental approach to trying to resolve our concerns. We made very clear that the original remedies that they tabled did not address those concerns. And I think they kept up their sleeve an opportunity to resolve the concerns more fully at that stage.
Now, the compromise agreement involving Ubisoft lasts for 15 years. What happens after that?
Yeah, so what we've got now is the sale by Activision to Ubisoft of the cloud streaming rights in relation to all of Activision's games content that exists now and all of that content that will be created over the next 15 years. And those rights are perpetual. So Ubisoft will continue to have rights over that content. That won't end. But obviously, 15 years is an incredibly long time in this rapidly developing sector. So our expectation is that competition will thrive and develop as a consequence of our decision today, and that the market in 15 years will reap the rewards of that very effective, open, competitive dynamic.
Obviously, the regulation of competition and the landscape affecting that has changed in the UK since Brexit. How important was this case to the CMA in terms of establishing your credentials as a global competition regulator with teeth?
We take each case on the facts and the evidence before us and take our decisions on that basis. We don't set out in any individual case to send any particular messages, but it is a case which demonstrates that we will stand firm where we identify concerns and that we will ensure that those concerns are fully addressed. And if they're not addressed, the deal will not be able to proceed.
You've had quite a busy time of it lately. I mean, this was obviously a huge case, but I mean, this week alone, you've said that you're going to look now potentially at the Vodafone 3 UK merger. You announced yesterday that you're looking into potential breaches of competition law in TV production. Have you got the staff that you need to look at all these cases?
Yeah, so we have a huge responsibility, I think, to the people and businesses of the UK and indeed to support the UK economy to make sure that markets are competitive and that supports growth and innovation and productivity. So these are really, really important issues that we are tackling. We do have the benefit of a strong position in terms of our resourcing and our budget, and it is necessary in order for us to carry forward the really important work that we're doing, not just, for example, in the digital market space, but across a whole host of cost of living related issues as well.
I mean, my broader point, Sarah, is that the CMA seems to be becoming far more activist. Do you worry that there is a diminution of competition more broadly across the economy right now?
I think we see many, many markets where competition is thriving and flourishing. And we see, a huge number of innovating businesses in the UK really getting the benefits of that competitive marketplace. And ultimately, of course, that's to the benefit of people who get lower prices and a greater range of choice. But it is absolutely our responsibility to take action where we see that competition is not working well. And that, particularly post-Brexit, is a responsibility that we take really seriously.
Sarah Cardell, always good to talk to you. Thanks very much for joining me today.
Thank you.
A couple of pieces of breaking news that have just reached us to bring you. First, the French Anti-Terrorism Prosecution Office has begun an investigation. That is after an attack in a school in northern France where a teacher was stabbed to death. That was in the northern city of Arras. More details on that as we get it. And secondly, you'll be aware that there's a row embroiling the FA over the lighting of the Wembley Arch. A lot of people would like to see the Wembley Arch lit up in blue and white to demonstrate support for Israel today. The FA not budging on that so far. England obviously playing Australia this evening in a friendly. Well, the Israeli professional football leagues have sent a letter. They've written to the Premier League, I think, following the decision not to white up Wembley Stadium's arch in Israel's colours. The letter says, "We are amazed, shocked and disappointed beyond words at the Premier League's lack of ability to condemn these acts. This is not about a conflict between two people. This is about leadership and the world where we want to live and raise our children. The Premier League must prevent radical Islamist ideology from expanding and contaminating our free, creative, diverse community and world with such despicable crimes." I'm sure we will have a lot of reaction to that throughout the morning here on Sky News. Some other business news stories for you now. And the UK's largest wealth management firm, St James's Place, confirmed this morning that it is carrying out an assessment of its fees and charging models. Its statement comes after the Financial Times reported that the company has been put under pressure by regulators to overhaul its complex fee structure, which includes both upfront fees and recurring annual charges, as well as exit fees for some customers when withdrawing their money. Well, the Financial Conduct Authority introduced new consumer duty rules in July, obliging companies to show they're acting in the best interests of their customers. Shares of St James's Place have fallen by 30% since then, and I can tell you that right now they are off another 15%. Shares of Avon Protection rose by nearly 5% this morning after the maker of gas masks, helmets and body armour said its performance in the second half of its financial year had been better than in the first half. The company, which was the best performing stock on the FTSE All-Share Index from 2010 to 2019, said sales during the 6 months to the end of September came in at $161.9 million. That was up from $101.6 million in the previous 6 months. It highlighted particularly strong sales for its helmets, for which it has currently some $59 million worth of orders. DD Global, China's biggest ride-hailing company, is reportedly planning to float on the Hong Kong Stock Exchange next year. The news comes 2 years after DD delisted from the New York Stock Exchange, where it had been valued at $70 billion, only for Beijing to launch a crackdown on its tech sector days later. The company was subsequently banned by Chinese regulators from taking on new customers, and its app was not available from mid-2021 until January this year. Insolvencies in England and Wales during September are up 17% on the same period last year. The Insolvency Service said there were 1,967 company insolvencies during the month, which was not only up on last year, but also up on September 2019 prior to the COVID pandemic. For the 3 months to the end of September, there were 6,011 companies declared insolvent, down slightly on the previous quarter, which had seen the highest number of insolvencies since 2009. The total number of individual insolvencies in September was down 27% on September last year. Well, still to come here on Business Live, we'll have a look at how the markets are doing this Friday morning. Don't go away.
I'm David Blevins, and I'm Sky's senior Ireland correspondent. I'm based in Belfast, a city transformed by peace, but still struggling with its past. Politically, the two sides are as far apart as ever, and it's over that question of who has sovereignty in Northern Ireland, the very issue that's been the source of tension here for generations. It takes 60 minutes to cross the Irish Sea. It took the British monarchy a century. I've spent 25 years reporting the journey from conflict to peace.
The political parties of Northern Ireland have reached agreement.
We help you understand the world with us.
Today, we have reached an agreement with the Conservative Party on support for government in Parliament.
We already know what the government gets out of this deal. What exactly does the DUP get out of it? Well, £1.5 billion. Welcome to Winterfell. It's an iconic location in this globally acclaimed drama. Ophelia was the most powerful hurricane this far east in the Atlantic on record. You can't live in a place like this and not appreciate the environment.
Fly Emirates. Fly better. Fly Emirates. Fly better. Thank you.
Well, the oil price has spiked higher this morning after the US tightened its sanctions program against Russian crude exports. A barrel of Brent crude is currently changing hands at $89 on the nose. That's up 3.5% on the session, although it's worth pointing out the oil price is still lower than it was at the start of trade on Wednesday last week. On the equity markets, last night's sell-off on Wall Street on the back of a higher-than-expected inflation number was followed by declines across the Asia-Pacific region. As you can see there, the big faller there, the Hang Seng in Hong Kong, off by nearly 2.5%. Well, here in Europe, stocks are all firmly lower going into the weekend right now, again on concerns over the US inflation number yesterday, I suspect. Talking points in Europe this morning include TomTom, the digital navigation specialist, has seen its shares fall by 7% in Amsterdam. That's despite it reporting a smaller than expected quarterly loss. Well, here in London, the FTSE 100 is also lower, currently off just under 0.5% lower. The FTSE down some 36 points. It would be down by 24 points more than that were it not for the oil majors. BP and Shell have saved the index from a heavier fall there. Elsewhere, well, St James's Place, as I mentioned just before the break, that is the leading blue chip faller, currently off by 15% or so. Another faller to mention today is British American Tobacco. The shares off by just over 3.5%. That's after the US healthcare regulator banned some sales of some flavours of its Vuse vaping brand. Outside the FTSE 100, the asset manager Ashmore has seen its shares fall by nearly 6%. That's on news of a drop in assets under management in September. Aberdeen is off 3.5% in sympathy. On the foreign exchange markets, meanwhile, well, it's quite quiet this morning. All of the main currency pairs not really moving very much. Sterling more or less unchanged against the dollar and the euro. Likewise, the single currency unaffected against the greenback. Well, joining me this morning is Sophie Lund-Yates, lead equity analyst at Hargreaves Lansdown. Sophie, good to see you this morning. What have you made of the oil price? I mean, everyone expected that we'd get a spike after last weekend's events, yet here we are. We're barely changed on the week, really.
Hi, good morning. Yes, you're right. It's been whipsawing around all over the place. And as much as the shorter term spike that we've seen, this is being driven by the narrative coming out of OPEC, obviously the main production cartel, which is saying that actually oil stockpiles are going to be down about 3 million barrels a day this quarter. So that is causing quite a lot of anxiety and pushing the price upwards on the short term. But as you rightly point out, broadly speaking, it's not moving that much. And a large reason for that is we've got this huge tug of war going on between supply concerns. But on the flip side of that, demand outlook is actually looking a little bit shaky. We've seen some weaker data points coming out of China. And there's a lot of confusion and uncertainty surrounding what the biggest global economies are going to be looking like. And that obviously affects the oil price in a big way. So there are supply concerns happening that are being made worse as well by the events of this week. But on the flip side of that, keeping things in a more stable fashion is the fact that the demand outlook is incredibly difficult to map right now.
Now, another feature that's caught your eye is the house builders, obviously in the doldrums. We've had a few profits warnings related to the housing sector this week, the likes of Travis Perkins and SIG, but the builders themselves are also under a cloud.
They are indeed. When we look at the FTSE, it's very much geared towards the house builders. They take up a reasonable chunk of things. And we've seen the likes of Persimmon, Vistry, Taylor Wimpey. They've all seen their shares down between 2 and 4% this week. And a large reason for this is frankly a lot of concern over what completions are going to be, completions being literally the construction side of things. And that is because that's being reined in because the housing market is creaking in the new build sector. And that, perhaps unsurprisingly, is stemming from the fact that we're in this higher for longer interest rate narrative. people are really kind of holding off on making those big life decisions, i.e. buying a new build. So completions are creaking. And there's a lot of anxiety. The GDP read that we've had this week from the UK, we're only just eking out growth. And a sluggish economy is not good news for people in the business of building and selling homes. So a lot to monitor there. But I would just add quickly, we're not in a situation here where the balance sheets are in real trouble like they were in the last financial crisis. So the balance sheet strength is a real positive and not one to be forgotten.
Yeah, good point you make there. Now, what about British American tobacco? I mean, the Americans have had it in for vaping since the days when Donald Trump was in the White House.
They have indeed, but the US has banned a menthol vape that British American Tobacco makes. It's the most popular, and this is why the shares are down well over 3%, closer to 4%, as you were just mentioning. Now, these NGPs, as they're called, so next generation products, which are supposed to replace tobacco in the fullness of time, is really an important growth driver for all of the tobacco majors. But at the same time, this regulatory move isn't a huge surprise. As you say, it's kind of been expected that the US was going to be quite heavy-fisted when it came to trying to squash products like this that are aimed potentially at children, inadvertently or not. So that's a big move today. And British American Tobacco still has a pretty resilient position in the tobacco market. The nature of selling an addictive product means that a lot of revenue is still very reliable, feeding into that 9 to 10% yield, of course, which is one of the kind of the cornerstones of the investment case for those prepared to take a bit of risk, because the valuation is in a very tricky spot, not helped by today's development.
All right, Sophie, got to leave it there. Good to see you as ever. Thanks for joining me today. That's it from me for the time being. I'm back at 4:30 this afternoon, and we will be bringing you a fascinating interview with the journalist and author Michael Lewis. His new book is out, and it's all about Sam Bankman-Fried, the founder of FTX. Well worth reading that. Do stay with us, though, because coming up after this short break, it's Sam Washington with all the latest from the Middle East. See you later. Cheerio.